Catherine Blazer, and I work with REI Live SRQ and Investor Quarters out of Sarasota, Florida. I am so excited to have George Famiglio with us. He has an amazing background that I know you guys all saw on your event when you grabbed your tickets, but he'll be sharing with us some tips that he's learned and some things that he as an accountant wishes that his new investors would know from day one, and it's just a wealth of knowledge. So thank you so much for joining us today, George. Everyone, we will be having time for questions towards the end, and I will put a chat box up. If you guys do have questions, please type them in there and we'll get them answered for you, okay?
All ready to go?
Yes, sir.
Okay, everyone. Good morning. I guess it's definitely a good morning. It should be a good morning all the time, actually. Anyway, we're going to specifically talk about new investment, new clients. If you're new to real estate, what do you have to do accounting-wise, some tips tax-wise, and some secrets to try to help to keep your costs down, but most importantly, to save taxes and to really know what you're doing. And I'm going to tell you some pitfalls that a lot of accountants, not accountants so much, but a lot of new investors get into, and they wonder why it's more complex than it has to be. It doesn't have to be complex. It can be easy, and I want to make sure that you know that. And hopefully, we're going to cover a lot. And if I miss something that is on your mind, maybe not my mind, I'm happy to answer it near the end. Anyway, what we're going to do is let's make up a new client, okay, a new taxpayer, a new investor, a real estate investor, a brand new. You got a flyer in the mail. All of a sudden, you talk to some of your friends, and they say, hey, the great thing to do is go buy some real estate for investment. And you might wonder, where do you go, okay, or what do you do? Well, there's different types of real estate investments. I'm not going to belabor on all of them, but I'm going to mention a few. And if you have any questions at the end, you can always ask, and I'll be interrupted if I have to be. Okay, now, so you could be a flipper, you can be a wholesaler, and some of you might already know what that means. And if you don't, I'll explain some of them. Okay, you could be a renter. I mean, usually there's two sides of real estate. There's those that just want to buy properties for cash flow, for renting, owning it, for building up, the advantages of real estate. Now, let's just talk. I'm going to start with rentals for a while, because that I mentioned with some of the advantages. Well, obviously, the advantages are more than one. There's cash flow. If you have a mortgage, whether it's private equity or private mortgage, or you actually got to the bank for your first one because you accidentally told the bank you might be living there. I'm not suggesting that you do that, but I know people do that sometimes, or whatever, or they have a house and they decided, okay, we're moving out of that house, we're going to buy a second house, and the first house we're going to rent. So you already have a normal mortgage, okay? Well, okay, so you have potential cash flow, okay? You have capital appreciation, and there will be capital appreciation. Don't listen to some of the newscasters, everything's gloom and doom. I want to tell you something. I want to take a little detour here, Catherine, for a second. Many of you know this, many of you don't. Not only do I love real estate, but I have 400, 500, 600 clients around the country, not just locally in Florida, in 37 states and 7 countries that invest in real estate. And real estate is my background. That's what I do. And that's why I say I love it. Okay, so all my richest clients, and I'm not here projecting that everybody has to be super rich. I'm talking about the richest clients that are really successful. 90% of them all did it through real estate. That's a fact. That's just not a maybe. That's a fact. Okay, so that's why I've seen it. I've tasted it. I smelled it. I heard real estate. I tasted real estate, all the above. And that's why it sounds like maybe I'm selling something. I'm selling just intelligence. I'm selling something that's smart, okay? And I have no axe in the game. Yes, I'm a landlord. I've had over 100 properties in my lifetime, okay? Well over that, okay? And I have rentals that I own now on my own and through some partnerships, okay? I like that a lot, okay? But that's a way you have cash flow, you're paying down the mortgage, let the tenants pay your mortgage down. If you have a mortgage, the rents will pay that down. I've had properties I bought in the late 80s. Today, I bought 13 in one deal. Today, I own 10 of them. And the mortgage is paid off. They're paid off. The tenants, I didn't pay the mortgages off, the tenants did. So then you also have tax advantages. This is what the new investor needs to know. There's cash flow, there's capital buildup through paying down the mortgage, there's capital appreciation, okay, and tax advantages. So that's on the rental side. And people sometimes say, oh, that's a pain in the ass. You have no idea how many accountants tell me. And I hope I'm not offending anybody. As a matter of fact, I don't think I am. Okay. But you know what they tell me off the record? Some accountants, how do you put up with these crazy real estate investors? How do you put up with them? They're all losing. That's the farthest from the truth. See, you know bull when you hear it. And the same accountants that talk like that talk about multi-level marketing. And the multi-level marketing, this is not a course today on multi-level marketing, but you'd be surprised how many people have done extremely well. Well, this is about real estate. So real estate is not phony. I like to say this because I hear it all the time from some accountant. I'm going to call them acquaintances. I don't hang out with them. I'm not going to call them friends, even though I'll treat them as friends. I'll be kind to them, obviously. But they tease. They say, you know something, everybody I know, because it's all hearsay. It's all fake news. It's all that nonsense that you hear around. Anyway, so you got the rental situation. And then on the other side, you could do flips. Some people say, I don't want to be a landlord. I just don't want to be a landlord. I want to flip properties. I want to invest in a property. Me and my wife or myself, we're going to go over there. We're going to paint that house. We're going to use some different colors, little tricks that the husband or somebody's learned over the period of years with drywall and spackle and everything. We're going to make that thing. We're going to fix it up, maybe put some new cabinets in, maybe put tile floors, take the old smelly rugs out and put new tile on the floor and all that kind of stuff. And what you do to juice up a property to flip it. And usually you're going to, buy and sell it within a year or within 3, 4, 5 months. Sometimes people want to do that, want to hold it over a year to get capital gain treatment. If you do own a property and you hold it over a year and you're not determined to be a dealer, the dealer is going to be covered next week, I think, in an advanced tax seminar that I'll be given, approximately the same time, same station. Okay, so, but you're going, sometimes if you hold it over a year, you get special tax treatment. You get a cheaper rate. But most flippers don't hold it over a year. They want to get in, they want to get out. They want to make that quick $5, $10, $15, $20,000, whatever they're going to flip, probably more in some cases, depending upon where you're at. So that's another side of the game. So it's really like flipping, wholesaling is sort of like, you're taking a contract and you're going to flip the contract or whatever. And there's different variations. We're not going to talk about the details of that. I'm sure there's other seminars that go into that. But that starting out, that's what you have. Now the key is the accounting. Now, why is accounting so important? Because you have to report it. You want to know what you made, number one. So there's 2 types of accounting. 2. One's financial accounting and one's tax accounting. You might say, what the hell? I thought it's all the same. No, it's not all the same. Financial accounting you do for yourself. You want to make sure that you're not tricking yourself, that if you're going to flip the property, you buy something. And by the way, I'm going to diverse for a second. I think everybody knows that you make money. I'm going to ask a question, but I don't think there's no show of hands. The question is, do you make money when you buy or do you make money when you sell? I'm going to give you the answer. You make money when you buy. If you overpay for something, real estate might be a little forgiving and maybe you get out of it and maybe you didn't get your backside too tanned or hurt, okay? Or you didn't get your toes chopped off, okay? But sometimes real estate sometimes has a way of forgiving itself if you hold it long enough. But you really make money when you buy. So if you buy right, okay, and then you have a budget, and the budget, okay, we're going to buy this house, And I'm going to use a low number just because it's easy for us right now. Let's say you buy a house for an old house for 100,000. You stole it. Okay, maybe you decide, hey, I think I'm going to put $25,000 into it. Okay, now these numbers might not have much with reality, but let's just use the example. Okay, so you put 25,000 into it. Okay, you spruce it up, you make it pretty and gorgeous, and you do your little thing with it, and then you maybe sell it for 175 after commissions or whatever and negotiations. Maybe you get 120, so you made $25,000, $30,000 on it. Okay, so you want to know what you really made. Number one, knowing what you really made is called financial accounting. That's for you. It's not for me. It's not for Harvey, Joe, Mark, Susan, Sally. It's not for somebody up the street. It's for you. Number two is tax accounting. They're usually very close. And we're going to get into how to operate your new little business and what to deduct in a second. Okay, but if tax accounting is done to create or to report on the tax return, and we'll talk about that a little later too as I go on, what type of tax return. For new people, it's critical. It's critical. Okay, so you want to know what you're going to pay taxes on. Now, remember I said there was tax advantages to owning real estate, especially for rentals. Okay, and I'm going to say this in case you say, hey, I'm new to real estate. I haven't even bought a property yet, but I like them both. I like to rent. I want to get some rentals, but I am jealous, and I want to have that excitement of a good flip. Just a good flip. Just a good flip. I want to do that. I want to have a good flip. Okay, because I want to make I think I'll go home and I'll say, man, I made $20,000. Oh, that feels real good. Okay. There's an advantage of doing both, actually, if you're in real estate full time, because you can have some losses from the rental properties because of depreciation. See, so if you have a rental property, the basic rule is, okay, you take in your rents. So let's say you rent for $1,000 a month. I'm making easy numbers here. Okay, somebody might say, hey, I'm not going to rent for $1,000. I want to buy a property for $1,500 a month. Well, I don't really care about that. Right now, it's $1,000 a month, so you get $12,000 a year. Out of that, you're going to pay some insurance. You're going to pay interest, mortgage, if you have one. Most people will. Okay, whether it's bank or private financing, you will. Okay, and then you'll have real estate taxes. You'll have supplies. You'll have repairs. Okay, maybe you'll have homeowners association dues or condo dues if it's a condo. Now, I'm a little biased with condos. I'll be honest with you. Maybe I should say this, maybe I shouldn't. If you're going to buy a condo, you got to steal it even more so, because there's so many condos on the market. Okay, so remember I said the secret is buying right. So with a condo, if I was to buy a condo, I'm going to be a little more concerned and push a little hard. I want to get even a better deal, because of course, if you know it's a good deal by comparing it to all the other purchases and knowing your product. It's not like you're going to buy a house and say, my wife and myself, or I'm going to go there after work and sit across the street and worship it like, oh, it's so pretty, the bricks are so nice on that house, etc., etc. We don't buy for that reason. That's nice if it occurs, but you're not doing it because it's so pretty or so beautiful. Okay, anyway, so now you bought your first property, or you got something lined up. You're going to do a flip, you're going to do a rental, whatever it is. Now, let me just say about the beginning legal structure. Okay, now this is basic. This is not what I'm going to go into in a more advanced seminar on taxes. Okay, well, if you're serious about real estate, if you're real serious about it, you could not be. You could say, hey, I'm going to try one or two. I'm going to go out there and just do one or two. Then you don't have to go crazy with it. And I say crazy, setting it up really involved. But I tell people from the beginning that if you're real serious about something, do it right. And we're going to talk about LLCs right now, limited liability companies. People sometimes ask, especially new people, what the heck is a limited liability company? Now, I'm going to go through this illustration. Some of you that know me know that I've said this a handful of times in the past. So what happened back in around the early 70s. Okay, Wyoming started the LLC. They say we like it. It was good for small. It's good for you and me, small business. Everybody's taken off on it. They have less rules with the legal structure. You could be sloppy. We don't tell people to be sloppy, but you can be sloppy and not do minutes and not do all that stuff and not just go crazy with that. Okay. And then Florida came along in around 84-ish, and they started one. And then by 1994, approximately, my dates are not perfect, and I don't care for them to be perfect. All states except Louisiana started it. So here's the key with that. They're easy to form. I have many clients with 10, 15, 20, 30. My largest client probably has 50 or 60 of them, maybe even more than that. Okay. So they're people, it's nice to be used. Now, you don't use it for every property, and I'm going to talk about that in a second. So these LLCs were formed by 94. Everybody, all states except Louisiana, like I said, had the LLC statutes. Again, it's good for me and you. It's nice. You don't have to have a big board. You don't have to do a lot of things. But here's the secret. Here's the meat. In 1995, IRS came along and they actually pulled their hair out. Okay, they pulled their hair out. Say, oh my God, what's this LLC? We got personal taxation. That's 1040 taxation. We got partnership taxation. That's 1065 taxation. We got corporate taxation. We got S taxation. We got trust, limited partnerships. We don't need another form of taxation. We have to go back to the Congress, and Congress has to make it some new rules up. We're not going to do that. So they did the unthinkable. They made a buffet. I always said in the past, a Chinese American buffet. I don't know if I'm going to continue saying that. That's a joke. Okay, I don't know if I should or not. But it's a buffet. They actually gave us a buffet. And you know, in a buffet, you get to pick. You might pick only 2 items, maybe 3 items. But in this buffet, we have 4 different items. We have 4 types of taxation. So the beauty of it is that we get to pick the result. The first result is a disregarded entity. Now, this is not advanced here. This is what a new person needs to know. Okay, a disregarded entity means, hey, you don't file any separate return, and that's not the issue. It's smart to file a separate return, which we'll get to. Has zero to do with extra money. Has zero to do with that. And you slop it on Schedule E or Schedule C on your return. Okay, you have a partnership. Say a husband and wife automatically buys it together. That's a partnership. Or maybe 2 brothers, or a brother and a sister, or 2 friends. That's a partnership. It defaults. That's the default structure. If you have more than 1 owner, it's a partnership. Then you also have, you can make the election to be a C corporation. You're not a corporation. You're an LLC. But remember, there's 2 different structures. It's like putting a turkey in the oven. You have the tray, and then you have the meat. The tray is the legal structure. God forbid you put, if you go home, you're going to make something and you're a little crazy one day and you stick the tray in the oven and you cook the tray and you say, I'm going to have something to eat. You pull the tray out for your family and there's nothing in it. They think you belong in a mental hospital. It's silly and stupid. It just doesn't go anywhere. But if you put the meat in the oven without the tray and cook it, you got 2 horrible things: a dirty oven to clean, and probably, and I've never tried this, so I could be wrong, a dried up piece of meat, whether it's chicken or turkey or whatever it is. Okay, the tray the lawyers call a shell. That's the legal structure. The meat is upstairs. It's the planning, it's finance, it's what we're going to save, it's the tax structure, it's the method of accounting. And that's what this is. This is a basic course, and that's why I'm talking like this. So there's sometimes, like if you're a flipper and you want to do, like, you're going to flip, you want to keep less than 5 houses a year, or 5 houses that you're flipping inside a type of LLC. You want to be an S structure, and we'll talk about that in another seminar. Why? Okay, but that'll save you some money. You won't have double taxes if you do that, because if you do too many flips, you could be entitled to the term dealer. And with a dealer, you're not allowed to use 1031s. You don't use installment sales, all the goodies with real estate. Some of them will go bye-byes, okay, when you're a dealer, okay? and you'll have an extra tax, an extra Social Security tax. So we try to stay away from the dealership. And the way you do it is it's not perfect. You just have more than one LLC. Okay, it's not perfect though. Anyway, so if you're a renter, you really want like to be taxed as a partnership. Again, this could go even more complex, but that's for another seminar. Okay, so that's the beauty about setting up an LLC. And you also do it for privacy. Okay, you might say, oh, George, I'm not so sure. We'll just put it in your own name. It's not wrong to put it in your own name. But if you're real serious, I don't know. Do you want to, you know, with the internet today, do you want some guy going around and saying, hey, Margaret over there, or Marilyn, or Brent, or Grace, or Bob, or Lee, or whatever, Ethan, Chris, okay, you want them to say, my God, that Robert guy down there, okay, he owns like so many properties, and you know, and check them out on the net. If everything's in your own personal name, some people might not care. I personally do care. I like to keep it to a minimum. It's called privacy. And that's another advantage of the LLC. Another advantage of the LLC is privacy. And that's why you do it. And sometimes you do that through land trust. That's a subject for another day. Okay, that adds to it. Doesn't give you more asset protection. It adds to privacy. It's a really unique way of doing it. Anyway, so let's move on for the basic tax structure. And that's, again, this is elementary. And if you don't understand, I'm happy to explain later on. I could take questions by the end of today. Okay, so let's go to accounting, because I promised that I will also talk about some accounting issues, because some new clients ask, well, what do I gotta do about my records? Okay, what receipts do I have to keep?
Or why do I have to keep the receipts?
Yeah, there you go. You know, why do I, what do I need them? Whatever reason, okay? Here's what you normally do. Whether you have an LLC or not, it's always good to have a separate checkbook, okay, for rental. Let's pretend you don't have an LLC, because you say, listen, I don't want to spend that $300 or $400, or my lawyer wants $600, $700, $800. I don't want to do that yet. I just don't want to do it yet. Let me get my feet wet, okay? And hopefully the salt water is with your feet is not so stringent and you don't have a lot of algae in there, and you don't get screwed up or whatever. I'm just having some fun. Anyway, so I'm glad to see people going back to the beaches. That's been a big thing right now. People want to get the heck out of the house and they want some freedom, but that's beside the point. We know what we're all talking about here. So here is what you want to do. So we don't have an LLC yet, but this applies whether you have an LLC or not. You want to have a separate account. If you're going to do it in your own name, go to your bank and say, you know, Bob Schulmeicher, whatever the name is, okay, special, you can call it special account. You might want to shut up and not tell them that it's going to quote a rental account. They might charge you business prices. I haven't done that in a long time, so I don't know if they're free anymore or not. I really don't know, and I really don't care. But sometimes you can have 5 accounts, 100 accounts in your own name. You can't or go to a different bank. Go to a different bank if you have to. But keep everything, and remember I love this food analogy that I've been giving you with the turkey in the oven. Let's progress to a funnel. Think about a funnel. When you cooks are using a funnel in the kitchen and you want to funnel something into a big jar or something, you're going to use a funnel. That checkbook is your funnel. Okay, so the rents go in there. Okay, and if you're flipping a property, if you're going to, okay, I'm going to put $10,000 in that account, or 5,000, because I'm going to do some repairs. Stick that money in and call it a loan, even though it's a loan to yourself. That way, whoever's doing the taxes doesn't accidentally, and it's very easy to do because the client doesn't do it all right. We're going to talk about that with QuickBooks in a second. Okay. If you know, all the deposits are usually rent, but if there's a loan, somebody's borrowing your mother, you're borrowing some money. If you're borrowing money and you're putting money from your grandmother, your mother, your sister, your brother, your kid, whatever the case is, and they're going to help you out, make sure you code that right, because you don't want to be taxed twice on it. It's easy to do. It's one of the biggest mistakes around, but you know, nobody knows about it unless you code it right. And that's why bookkeeping and accounting is so important. Use that funnel. The funnel's the checkbook. Don't just say, oh, I didn't have money in there, and I went to my personal account and I paid the electric bill 1 month because I was short. That just makes it really rough, okay? Because you really should have everything going through that funnel. That one funnel, the money goes in and the money goes out, okay? And the money that goes out should be business expenses. Now, I said the basics. I said taxes, utilities, advertising, insurance, HOA fees, condo fees, whatever your situation is. But you also have some other costs. Let's say you got 2 properties, 3 properties. You got car expenses. If you got 3, 4, 5, 6 rental properties, or 3 or 4, 5, 6 flips that you're working on, maybe you have enough business to have your car lease, your car repairs, your car insurance, and then you have to adjust that based on personal usage. But that's easy. At the end of the year, in our office, we give everybody a form and they say, hey, I drove 18,000 miles this year, by the way, and we like it to be exact, of course. But then 12,482 or 14,582 was done in business. So we're going to take a percentage. That's what you do on the tax return. Okay, so you can do stuff like that. If you're really involved, you got your cell phone. I know this is peanuts, but everything helps, because whatever you deduct, you're going to save something on. You have internet because you do a lot of your business when you're searching for properties. You're doing business on the internet. Okay, you got those kind of costs. Maybe you're paying for seminars. Maybe you're paying to belong to different groups. That's all deductible. Continuing education or going to meetings, real estate meetings, if you do it right, it's all deductible. You got to make sure you capture that. That's what the funnel principle is. It's called capturing it. If you don't capture it, we're not, we don't have angels outside as like CPAs. I'm not an accountant. I'm a tax accountant. A huge difference. Most accountants are accountants. Okay, they do taxes, yeah, but I have a master's in tax from Villanova Law School, and this is what I do. Plus, I have a lot of real estate and a lot of experience. So I'm telling you, this is internally. This is where you screw up by not capturing all that. We don't want to see receipts. You should have the receipts. That goes in your nice file that you keep under the property. But we're going to take your QuickBooks, and the QuickBooks, most people use QuickBooks. So if you use something else, or some of the clients developed their own Excel spreadsheets, that's actually okay too. And there's a lot of examples on that you could search on the net and try to download stuff if you want to, if you like Excel so much. Some computer guys love Excel. They don't want to use QuickBooks, but they do it right, okay? But remember, it's the funnel principle that you got to capture everything. So let me go back to like some expenses here. So you might say, one idea that might come up, well, George, I don't write too many checks anymore. You're talking about writing checks. Using a debit card or a check is the exact same thing. If you set up ACH transfers, okay, you have your real estate taxes online paid, or however you do it, that's like a check. So it's just like Kleenex. It's just like Coke. There's Coca-Cola, there's Pepsi, there's RC. I call it all Coke. I could care less, okay? It's the same type of principle. So don't say, hey, I like debit cards, by the way. I'm going to bounce around. That's the way I am. I like debit cards, by the way, because that is like a check as opposed to a credit card. Most of my clients use credit cards. I use credit cards because I'm old school or whatever. I've always had credit cards, okay? I don't keep them going month to month. We tell people not to do that. But sometimes if you're doing a flip and you're really leveraging yourself, you don't mind paying a little extra interest if it's really business related. And if it gets you to finance it for a month or two, that's fine too. So I'm not against that. But we want to capture those payments. Now, one thing about credit cards, if you have a credit card statement and your bill comes in and it's $1,500 that month, you don't get a deduction for $1,500. People are I see people in my mind raising their eyebrows. They don't know what I'm talking about, so I'm going to explain that. That $1,500 that if you say, George, I pay my credit card off every month. I know, but your deduction is not $1,500. Your deduction is $200 for gas. It's $300 for supplies. It's $400 for repairs. Whatever you charge, it adds up. It has to be separated out. Now, on that note, let's talk about a multi-property company. You might say, I'm not a company yet. Let's pretend you're a company, because it's just a matter of terminology. It's not that critical. Okay, if you have 4 rental properties and you're using QuickBooks, you got to make sure that each property is in a different class. Now, that class is a term inside a class, QuickBooks. It's like Walmart. Let's go to a big level. Walmart has how many divisions? It has a closed division. I guess they still maybe an electronic division. It has a food division, whatever they have. Then when Walmart is looking at that one store, they got a financial statement or income statement under each division. They call it division. In QuickBooks, it's called a class. The class will be 1520 South Main Street or 8565 Osprey Avenue. And I don't know what these properties are. I'm just throwing out numbers, okay? Or 1520 Broad Street. That's where my dad used to work in Philly. Okay, so I bring that out. Anyway, but that's how you do it. You can call a class. And so if you have some repairs that you're going to that one property, don't just put it in a repair account, because we have to separate it out. And we don't like doing it. As accountants, we don't like doing it. We charge more. We'd rather make money other ways. So I'm telling you the real truth. Sometimes the staff accountants in my office, I have 18 of them. Okay, sometimes in my office, they're pulling their out. Don't give me that client. His books are horrible. He merges everything together. See, there's 2 ways of merging things together. Merging one property versus another property. So each property should be separate, and that's why the class. Or merging a different checking account that has nothing to do with your business, and say, oh, George, didn't you guys know out of the personal account, I was short, so I decided to pay 10 bills out of personal. You should have known better. No, we don't know better. We never will. Okay, and if you give it to us, we're going to add it, of course, but it's just sloppy. It'd be much better to have it go through your business account, a separate account. Okay, by company. I've had a couple clients over the years that have 3 or 4 LLCs, and before they came to me, they were putting one LLC was paying for the other LLC, and that LLC was paying for a third LLC. Get away from that. That's called commingling. You don't want that to happen, because you could hurt yourself. Okay, we have to separate it, and we're going to have to, if you get audited, the IRS will they don't like it either, and it's just a stumbling block.
So George, I got a question for you really quick. For the new investor that's maybe going to start out with wholesaling underneath their umbrella, and then maybe add a rehab in underneath that, how do you recommend engaging and tracking the wholesaling? Is it its own class in QuickBooks, and is that what you're putting all of your mileage in, going back and forth before you put a property underneath its own class for your flip? Or how do you keep track of all of that when there's wholesaling and you're looking at so many different properties and so many different things? Do you have like an overhead class? Or
no, matter of fact, that's exactly right, Catherine. You'd have an overhead class. See, because you're doing everything, you're not going to allocate cars to one property. Just it's going to be just overhead. So you can call one division called overhead if you like. If you like that term, that's what you could do, or just general expenses or general costs or management or whatever you want to call it. It doesn't really matter what you call it, but you're exactly right. You do not have to allocate cars. I have a lot of real estate people, they forget about cars. You would think that nobody would do it, but you'd be surprised. We educate them, and they change just like that, because it's a big deduction. Sometimes you get a $5,000 or $6,000, $7,000 deduction on a car on just mileage alone, and you're saving a third of that or 25%. So you figure it out. Don't be lazy. I say lazy because people are just procrastinators, and I'm not saying everybody. You don't want to be a procrastinator, and you don't want to be lazy. And that's just a cute term, the meaning that I'll get around to it. And it's, and we talked about receipts. You should keep receipts. We as accountants don't want to see receipts. Now, we definitely will always, always, always want a HUD statement. That's not a receipt. That's a legal document. Every property that a client of mine owns, we try to have the buy and the sell HUD statements. We keep them for a long time. We can't do the tax return, whether it's a 1065 or a LLC taxes 1120S, or even a personal. If it's a DRE, that's a disregarded entity. Somebody might say, I'm taking it easy. I'm doing everything on my personal return. I just want, for people that think that way, I want to just give you one thought. if you're really involved and you don't have a lot of separate LLCs for the future, your return gets nice and thick. It's called juicy. What do I mean by that? If you get audited, and I'm not in the business of some people that have heard me before, I don't sell fear, I don't sell paranoia or confusion. That's not my business. I don't do that. Okay. But if you get audited, you're going to be audited personally. And if you're audited personally, you got everything that's in that thick return, all the meat, all the numbers and everything. That subject could be subject to an audit. Little baby LLCs go under the radar. Doesn't mean you get to make up or cheat. That's not what we're not saying that at all. But each LLC files its own little return, and you basically, and then when you go to your personal return, one or two numbers come over. And that's one of the beauties of it. Most of my clients that really get to understand that, that's one of their favorite things actually, but that's for another day.
I have one more question for you since we talked about receipts, which QuickBooks allows you to scan in your receipts now to keep everything organized. But for people that like hard copies, is it 7 years or 5 years that you need to keep your receipts for?
That's a good question. I know that I'm a big believer in scanning, big, and I'm glad you mentioned that too. And I'm going to answer your full question in a second. But I want to just say that that's a great way of organizing yourself. Okay, I think you should scan it, but make sure it's organized. You code it to the property when you scan it. However you do it, whether through QuickBooks or through PDFs on your own, whatever the case is. Okay, and now you mentioned. Let's see, what was that?
Link the time to keep receipts.
Okay. Oh, that's right. Okay. Here's the deal with that. There's no real magic. Where the 3-year came up with is there's a 3-year statute of limitations.
If you file your taxes.
Huh?
If you file a taxes.
Yeah, if you file a tax return. See,
returns, they can go back a lot longer.
Yeah, no, as a matter of fact, I'm glad you brought that up because I'm going to just mention something real quick on that. I want everybody to understand this because this is one reason, this is something everyone should understand. Forget about extensions for a minute. Let's say for 2019, okay? Sometimes I say 19, meaning it's 2019. We talk short here. That return, forget about the COVID deal and the extension this year to July 15th. Just forget about that a moment. That's normally due April 15th. With extension, it goes October. From that date of due or the date you actually file the return, you have 3 years to be audited. That's where the 3-year statute comes up. So you definitely want to keep your records over 3 years. We notoriously tell people 7 years, and that's just a smart thing. I mean, especially if it's PDF, if you don't have the hard copies. Now, I do like hard copies. I'm going backwards here, and I'm okay with that. I like the HUD statements. We want hard copies or PDFs or HUDs, and you keep them permanently. Now, of course, if you sold properties back before 15 years ago, you could get rid of those. But you got to keep the HUD statements longer because if you get audited within that 3 years, I don't care if you bought the property in 1990 or 1995. If it ever comes up, you're going to need a copy. So you don't get rid of the HUD statements. You know, you can after a while, but you really want to keep HUD statements. But the receipts for utilities and cell phone and internet, I don't go crazy over that.
So
Keep them for 3 or 4 years.
I have one more question on that. Do you recommend filing by your receipts by months or by vendor?
By vendor. You know, and if you have the right software, you can always sort. And the reason I say that is because if by the month, here's why. Some people say, this is my January file, this is my February file. But if everything's in there and then you need to prove somebody, you know, maybe the utilities, this is a silly example. It just comes to my mind. There's something wrong and the utility company, and you're trying to you have to go clean them out. It's so much better to have them, you know, by topic. It'd be nice to have both. With a PDF, you can search for both. If you have the right searching, you could do it, but that's the situation there.
Okay. So, and then just one other tip. is when you file by vendor, put the newest one in the front or in the back every time so that they're still in chronological order, and then put it back where it belongs. So you
Yeah,
don't have
that's like the my one of my construction workers, and I love my construction workers. I have a lot of them. Okay, you know, the joke is they have them. The receipts are all under the seat in the truck in the glove compartment. You know, so it's I like that. Put them in the front. See,
yeah.
we don't need the receipts because we're not auditing you. We just don't do that. But you need them in case you get checked. And that's rare. Just because it's super rare doesn't mean you can get by with not doing it. It's best to do it. You know, get a methodology to yourself. Just do it. Okay. And that way you don't even have to worry. Just the same thing all the time. Make it easier for yourself. You don't have to think, where do I have to put this? Just do it. Just put it away. Get a habit. It's one of the great habits of a successful person. And this is not about Covey's successful habits of success, but you know what I'm talking about. Let me see how we doing here. I actually it's getting to be around 12:11, so let me see if there's anything else I want to talk about. Oh, one more thing for new people. One of the deductions that I alluded to is depreciation. Okay, depreciation, you don't depreciate properties when you're flipping. You depreciate them when you're renting. Now, you might have a car, you might have a truck, you might have a van, you might have an SUV that's going to be in the name of the company or that you're going to be using for business, and you might depreciate that, but that's general. That's going to be over all the properties, okay? But depreciation for rentals, it's really critical because, you know, residential properties can be depreciated over 27 years, not land. You have to back the land out. If it's a condo, there is no land. Okay, sometimes people do when it's super high end, they back a little bit out. That's a case by case basis. But usually you figure out a certain percentage for land, which a lot of times, when in doubt, you go off the website of the county where the property is, and they have a different value. We use the ratio there. That's all we're looking for, because the value that they have has nothing to do with reality all the time. You might have paid $250,000 for a property, and they have you down for 190, but they have the ratio of the land. So depreciation is a non-cash expenditure, you know, not even an expenditure, expense. Okay, I should have said. Okay, but you get to write that off. That's one of the advantages of real estate. You get to write off your interest, and you get to write off all the expenses. It's not like your house. Your house where you live in, you can't write off your utilities. You can't, unless you have a home office. Now, if you have a lot of properties and you have a home office, that's another story for another time. You can get a little home office deduction. People say, no, I'm not going to do that because that's risky. If you have an LLC, it's not the same thing because you don't have a home office form. You just have rent, and you pay yourself maybe a rent check every month, and you rent your home office. Anyway, I guess we can go to questions now, unless Catherine, I'll talk and I'll talk. So I think we decided at 15 after. Am I right on that?
Yes, you are. So there are a couple questions in here. Looks like Jesse's put some comments, and you were very close on your dates. Leanne has a question about, in your experience, what type of real estate investors are most likely to get audited, and can you do to reduce the likelihood of getting audited?
Oh, that's interesting, because I actually have something I tell everybody about that. That's one of the reasons I love the LLC so much. I'm a man of illustration, so I guess we're in the food analogy today. This might be the real estate food channel. I don't know what it is. Okay, let's pretend we have two big bowls. Okay, and one bowl is, and this is how the IRS thinks about auditing people. One is going to be the individuals, people. Okay, now at the top you have people that make over $100,000 a year. So just think, if you have a big soup and you're straining the oil off the top because you made your own chicken soup with vegetables. It sounds like I'm getting hungry here. So you're going to take off the oil and you're going to skim it. The people at the top are the ones that make a lot of money. Remember I told you that principle? The thicker your return, the juicier it is. Okay. So at the very bottom, you might have some fella that has 8 kids. I'm going to give you a vision in your mind. And he works at the concrete plant. okay? And with 8 kids, let's talk about the law from 2 years ago, so it's a little different, okay? No, who's going to audit him? Him and his, his wife has a job. She has 8 kids at home, okay? He works at the concrete plant making $45,000 a year or whatever, okay? Nobody, the IRS would be stupid to audit him. There's no money there. It's marketing. That's all it is. They want to go where the getting is good. I'm trying to be a little crude, but that's, you hear what I'm saying. They're not going to do it. So let's go to the second bowl. The second bowl is companies. At the very, very top, we have Tropicana, we got Anheuser-Busch, we got Apple, we got IBM, and at the very bottom is you and me and us with our LLCs. They're little baby LLCs. I don't care, you might think this is kind of silly, but it's far from silly. Okay, so it's not like we're scared of the IRS because we're doing the right thing. You're keeping the good books, you're keeping it smart, you got your backup, but you go under the radar. You're just nobody. You're just a little tiny fish in the sea. Doesn't mean you do something wrong. I want to make sure everybody understands that. You do things smart, intelligence. Because sometimes it's intelligent to be conservative and sometimes it's intelligent to be more aggressive. Okay, but you're at the bottom of the sea, and the IRS is going to audit the big boys first, the big girls first. Okay, so that's pretty much it. But the percentages are really low, sometimes 1 or 2%. I mean, they're really low. Doesn't give you a right to do something stupid. Okay, you want to prepare for the audit by ease, not by sleepless nights. You want to do it by ease, by keeping those receipts, just like Catherine was bringing out, and all that stuff. Does that help you?
Did that answer your question, Leanne? While we're waiting on her to respond.
Thank you. Yes.
Okay, perfect.
Leanne, if you have another question on that, I'm happy to talk about it. Hopefully that answered it all.
Yes, it did. Thank you.
You're welcome.
So we hit on a couple things, and I kind of just want to maybe lay it out a little bit differently for people. When you are getting into real estate, write down all your expenses and write down where you're spending money on advertising, because you want to reconcile those expenses with what your bank statement says. That's one thing that we didn't hit on, is the monthly reconciliation opposed to waiting till the end of the year. And how important
that you need to reconcile your bank statement every month, because the banks do make mistakes. That's how you can catch it. Believe it or not, they do make mistakes. I mean, I could tell you stories from years ago, but I won't waste the time right now. But sometimes banks will make mistakes, and it's your mistake and their mistake sometimes. So you want to make sure that nothing got through, or somebody, especially with identity theft today, somebody could have maybe attacked your account, and you might not know it for months unless you check it every month. I have people that just wait and they just don't check their accounts or balance it. So that is an absolute necessary procedure. Absolutely, you should have that in your card of tricks, your bag of tricks, or whatever you want to call it.
Yeah. So if you write down everything and everywhere that you're using money for your business, and your time for business, if you keep a really good record of that for the first couple months that you're doing this, you'll have an idea of things that you're using, and then you'll become a habit. Oh, this is something new that I'm doing. So we talked a little bit about putting your car in your LLC and depreciating that. We talked about properties. Are there any other small things that investors miss out on that are new that they learn as they learn the ropes? Any other tricks? Maybe a cell phone?
Cell phone, definitely. I mean, if your cell phone, yeah, I should say not definitely, but definitely most of the time. I don't have a client that doesn't write off their cell phone. I mean, technically, if you bought one property, okay, and you have one rental property, you shouldn't be writing your cell phone off for the whole year. It's all relative, but most people that are in real estate, they're jumping into the water because they want to do really well, and they want to buy more than one property. It's rare to have a person just buy one. I mean, it happens. I mean, I have a lot of clients that have one rental, but people that, like this group, that is really looking out for real estate, they're not doing it just for one property. Now, I could stand corrected, but I don't think so.
Grace, I know that you unmuted yourself. Do you have a question?
Yes. What I do is I usually get a credit card for each property. So when I go out there, I just do my purchases on a credit card. and I don't save the receipts. Do I really need to save the receipts if my American Express credit card statement has all the information on there, and I code it on my statement, and I also write down like who I had lunch with, etc.?
Well, Grace, nice to talk to you again. I recognize
Yes.
you for another
Thank
time.
you, George. Nice to see you.
I told you that your voice is unique, and I mean that with a positive comment. There's nothing wrong with what I said. Okay.
Yes, thank you.
I remember I told you I have a client that you could pass for a sister. I'm not joking. Anyway,
Yes,
you remember, I know you do. I'm just teasing
yes,
you.
I do.
You know, technically, that's a good question. The reason why, it's always best to keep the receipts, but I know, see, I'm kind of a little spoiled myself. I mean, we keep it, and I can't tell you not to keep it. It would be wrong for me to tell you that, but the odds are if you got audited and it was self-evident based on your monthly statements from Visa, MasterCard, or Discover, or whoever, okay, it should be fine. But here's where it wouldn't be. But this is a remote chance. I mean, the chances of being audited, just like I talked to, I think it was Leanne that we just talked to, the chances of being audited are really remote, okay? But if you were audited and you had something from Target or Sears or whatever the case is, you want the whoever, okay, you know, Dillard's, I don't know who's still in business today. We will find out soon, okay? And you bought maybe, you know, you could go there and probably buy a bed. You could probably buy, so the IRS is going to want that, okay? But if you bought a bookshelf or a desk for your home office, see, that's different. So I'm going to answer that within reason. I don't believe in going crazy and keeping every little tiny receipt. But if obviously if you're trying to prove, you know, gas, obviously if it's Exxon or Amoco or one of those, obviously that's gas, okay? But if it's something that could be a personal thing, they're going to want to know it. So, and you know, it depends how material it is. You know, if you got $10, $15 a month because you're paying a internet service for a feed or something, it could be music. Music's technically not deductible, but if you play your music in your office and that's what you do, fine. I subscribe to some educational services that have a lot of different types, you know, my computer education, some accounting, some, you know, I have a studio in my house. I'm a musician, but that's beside the point. Some are music oriented, you know, I'd have to prove that, okay? And it probably will never come up though. That's what I'm thinking.
The only
Okay,
thing
thank you.
I'll say is you want to check your receipts and what you're spending against your bank statements, because there's a lot of times that there's double charges ran and tips been reported incorrectly and things like that I noticed through keeping up with my receipts for when I did pharmaceutical sales. So that's one thing to consider also is sometimes, I mean, George said it, banks make mistakes and so do credit card companies, and the person keying it in at the end of the day at the store. Robert, Leanne, 1 second, I'll get to you because I know that you unmuted. Robert has a question about wholesale assignment fees. How is a wholesale contract assignment income treated? Self-employed income, taxable, any other way to get creative? I've never seen a title company report a wholesale fee. Whose responsibility is it to report the wholesale fee, the 1099?
Is this the Robert that I know?
Probably.
Yeah, I think so. Anyway, anyway, so so you're talking about a wholesale fee. It's a fee that's on the HUD statement. In other words, what I see a lot is, okay, you know, I got this contract and I'm flipping this contract. I'm going to wholesale it or whatever you want to call it. It's the same thing tax wise. People call it different things. You know, I have a client that talked about tax deeds and tax certs and she, oh no, I don't do it that way. They're tax wise, it's all the same. So whether you want to call it wholesaling or flipping, it's all the same. So that's a little tough situation. Okay, the tough situation there is if you do a lot of them, the IRS can view that as being a dealer. A lot of times on the tax return, we're going to show it as a on the short-term capital gain. especially when it doesn't happen that much, okay, as a flip of a contract. Because you see, on Schedule D for the capital gains, okay, that's based on capital items, and a contract can be deemed to be a capital item. Okay, just like an ownership in property, whether it's tenants by the entireties, tenants in common, or you have an equity interest on paper, or you might say, well, that property's not my name, but I have a contract that says that I'm going to help that person, manage that property, or I'm going to flip it for them, and I'm going to get $10,000 when they're done. Well, that is an informal partnership, and that could be an equity interest. So we try to show equity interest on Schedule D. But if somebody does this for a living and they might have 100 of them or 30 of them or 40 of them, that's a little different. I don't know if that answered everything.
That answer your question?
Hey, George. Yeah, it is the Robert,
Hey,
no,
Rob.
Hey, my question was, I paid a wholesale fee out a couple years ago for $18,000, and whose responsibility is it to, is it the title company, or am I responsible as the buyer of the contract and the property to send a 1099, or whose responsibility is it to get something back to the wholesaler?
Yeah, that's really interesting, because I'm just going to give you both sides of the coin here. Let's ask the question for a second. Some questions are rhetorical. We ask the question and we're expecting the answer. The rhetorical question would be, what are 1099s used for? Because that's how we need to analyze this. They're used for non-employee comp. They're used for royalties, okay? They're used for other income type of things. Normally, though, 95% of them are used for non-employee comp. In other words, you're paying somebody compensation. Now, yours probably came off the settlement sheet. I'm pretty sure that you would have, normally the title company would say, okay, unless you paid earlier on your own. So if it's on the settlement sheet, and if somebody doesn't do a 1099, I'm not going to say I'm okay with that, but it's a lot easier. It's if someone doesn't do a 1099, I'm not bent out of shape, because it's on the settlement sheet and you're really splitting the profits. You're buying the contract as opposed to paying him, her for working for you. It's very technical. We'll go a little farther if that doesn't help you.
Well, so now I'm curious, how do we trickle that down for the new wholesalers? Let's take that and how they reflect that income, because it's, with what you just said, it's not a service fee, it's what is it?
Well, it could be a capital item. See, it's better for us to show it as a capital item because it's safer from the Social Security standpoint. But you can't see, it's a judgment call. You can't do it one way all the time. Let's say you have somebody that he's in the total business of wholesaling. Well, that he's going to have an LLC tax as an S, okay? Because you want to shelter some of the dividends coming out of that company, because you don't want to have it where there's a double taxation. When I say double tax, we're exaggerating a little bit, because you have to have some kind of payroll, okay? But we're talking about income tax, and we're talking about self-employment or Social Security tax. Up to 130,000 now, Social Security taxes on self-employed people, okay, is 15.3%. That's a lot of money. You figure, I know all you real estate people out there, you could do 15% on 130 in a heartbeat. So you figure it's obviously well over $15,000. We'd like to save some of that. But if somebody's doing wholesaling as a business constantly, and that's their real business, you got to have an LLC, you got to put in an S structure. And if you're making, let's say, $100,000 net, okay, you got to have a payroll of something that's substantial, not huge, but something that's meaningful, because the rules say that you have to have a reasonable salary, and you really want to pay a lot of expenses out of that. Maybe what would be great is a nice pension plan, a private pension plan, if you're in that situation where maybe you could put 30, 40, 50, 60, 80, $200,000 away a year. And you might think that that's radical, but there are plans where you can put well over $100,000 a year. I have plenty of clients doing that.
Okay, so for somebody that's new in the business and they're going to focus mainly on wholesaling, you're saying set the LLC up as a S corp instead of the partnerships that we would normally do, or and then also doing it in a pension plan, or having them set up a pension plan.
Pension plan's extra. It all depends upon cash flow. Pension plan is a way to save money. And you could set up a pension plan and you could buy some land. You could buy something in your pension plan. Besides, I love no load mutual funds and I love real estate. They're the two areas that I like for pension plans. But what I'm saying is I want to make sure everyone hears this. Usually what you're going to do is do an LLC. See, an LLC is allowed to make an S election. It's not a corporation. It's an LLC like an S corporation. The reason you do that, for flips and wholesaling, if you do it that way, you try to lessen the risk of being a dealer. You see, if you're a dealer and you're doing it in your own name, you're going to get double taxed. You're going to have an income tax and you're going to be subject the whole profit, okay, with Social Security. That's another 15.3% on top of your tax rate. And the tax rates, under the new administration is 12%, 22%. They all went down. Everybody knows that. Tax rates are a lot lower now than they were 2 years ago. Okay, so even at the lower rates, let's say that because you have a lot of rental properties, you got your tax rate down to 12%, but you're going to pay 15% on top if you do it as a dealer type, as a self-employed person. So you have an LLC, you make the S election. One thing I didn't mention, which I do 99% of the time or 95% of the time, it's also good to make a fiscal year election. Why have everything end in December? Now, some people, I have a few people that know me on this call right now. Some people already have their calendar year companies, because once you have it, you have it. But if somebody was going to set something new, I always go with a fiscal year. We're only allowed to use September, October, November since 1987. That's when the law changed. Before that, we were allowed for S structures. We were allowed to use any year, but we're now limited to September, October, November. And I do that about 95% of the time. There's some cases where I won't, but that's just an extra aside.
So Leanne had another question. Can you provide some tips on using the striker tax deferred exchange to sell one rental property to purchase another?
I'd be happy to talk about that. That's more in an advanced course, but I love real estate, and I'm not joking. It's not just a flattering type of thing. I'm not trying to tickle my ear or somebody else's ear. I love talking about that. So you're talking about the starker. The starker is when you reverse it, okay? There's different types, but we're going to talk a 1030 because it's a 1031. Now, here's how I explain people the 1031. I'll start that since this is a new beginner's course, okay? A 1031 is when you have an investment property or a business property. Business doesn't mean commercial. We're talking about a business property. It's not like a residential where we got a home, at the shore up north or in the mountains or something. We're talking about an investment property, a rental, or just land or whatever. It could be anything. Now, we can't do personal property anymore. That went away. But real estate is safeguarded that you're allowed to do the 1031. So let's say you have a property you bought for $100,000, or let's say that's the book value. You bought it for 200, but you depreciated it down to 100. And then you got an offer for 500,000. So we have a $400,000 profit. And you might say, I'm not going to pay 15 or 20% of that. Okay, that's a 20% to 400. That's 80 grand. You might say, hey, you know something? I like real estate so much, I'm staying in it. So what you do you take that 500,000 and you step it up a little bit. You have to buy over 500,000. Let's say 500,000 $1. Okay, you could buy. There's ways to buy up to 6 properties, but there's really complicated rules. Most people don't do that. 3 is easy. So here's what happens. You don't have to buy one for 600,000 or 520,000. You could go buy 3 smaller ones or 2 smaller ones. You have 45 days after you sell that property. When I say sell that property, that's not the signing of the contract. That's actually the settlement at the title company or the lawyer's office. Okay, I like lawyers' offices better for this too. If you do a lot of properties, you should get involved with a real estate lawyer, it's the same price as title companies. I just like it because they give you more hand holding.
We actually have Chad speaking at 2 o'clock today. So if you guys
Ooh,
want to stick
cool.
around,
Cool.
he's a local real estate attorney.
Yeah, I didn't even know that. Well, that's the kind of guy I'm talking about.
Exactly.
Okay. Why not? You're going to pay the same price either way. Some people say, no, I'm going to go to a title company because of the title company. You know, I'm going to save some money. No, I'd rather have a smart lawyer, you know, that knows more about the real estate law. I'm not downing title companies. They do a great job. But a lot of lawyers use title companies. They got to deal with them. Okay, so anyway, enough of that. So let me get back to the 1031 so we can keep moving. Okay, so so you want to go up in value. Now here's the secret. If you have a loan on that other property that you're selling, you got to go up in mortgage too. Because if not, it's called boot. Now this is for an advanced course, and I'll be happy to discuss it in a couple weeks or next week if it comes up, which maybe it should come up. Okay. If you go down, if you owed $100,000 on a property and the new mortgage is $101,000, that's great. But if you go from $100,000 down to 75, you have a chance that extra 25,000 is taxable. It's called boot. Okay, so you got to go up in property value. That sale price, purchase price, you got to go up with fair market value. You got to go up in loan, and you got to go up in equity. You only need 2 of those, but I tell people all 3 because if all 3's right, then you're not gonna have a problem. I overkill on that one. So that's what it is, and then you could have the reverse type of exchange where you buy the property first, but you got to have an intermediary. You can't do it on your own. It won't work if it's on your own. You have to have an intermediary, and you have to make sure you contact him or her or the company ahead of time, especially on the reverse exchanges.
Okay, cool. Awesome.
Thank you.
I have a question. Hi there again, it's Grace.
Hey.
Can I take my American Express bank statement and do a journal entry for everything that was purchased that month? And if I did not pay the full amount that month, just take the balance and put it into the accounts payable for the American Express account versus putting each transaction for the month into QuickBooks.
The way you're supposed to do it, because there is a special rule on this very subject, it was decided about 20 some years ago. When you charge something on a credit card, the deduction is the date of charge. If you're on a calendar year and all of a sudden you say, hey, December, I just paid $10,000 of expenses, but I'm not paying them until January 31st or February. That's not a deduction when you pay it. That's a deduction when you incurred. The legal term is incurred when you got the debt. So in other words, you charge $1,500 for for a new fence for one of your properties, and you bought it, you charged it on December 18th of one year, and you paid for it January 18th. It's a deduction the prior year, always. If you're not doing it that way, it's not correct. I think you are doing it that way. But your question was, how do I make the journal entry? The journal entry should always be, if you're going to do one journal entry in December, you're going to say, hey, let's just pretend that you paid $5,000. It'd be easier. But you bought 10 items. What you do is you do a double entry. The first entry is going to be the expense side, and you're going to list it under all your expense categories. And the second entry is going to be the cash that you paid out. If you didn't pay the cash out, then it goes to accounts payable, dash Visa, dash MasterCard or whatever. But you want to deduct all that in the day that you charged it. So you might have a Visa account or a credit card account, and during that credit card account, you might have things you charged, items that you charged 3 or 4 weeks. Okay, that should be by the date. So you might have something that you charged, December 2nd. The next one's December 5th. You should put December 1st, $200, December 8th, $500, and it should balance. I hope that helps.
Yes, what I do is I look at the bank's the credit card statement, and usually it falls into the next month. So I do the journal entries for, let's say we're in May. So in May, I get the statement. It might have a few May dates in there, May purchases, and then most of it will be in April. So I'll do a journal entry for the expenses for April and post that in April, and I take the expenses for May and I post it in May. That's how I do it. I do separate it.
It's okay. The only time that it's you have to watch it is at the December 31st.
Yes.
Because if you want the expenses in December, they're expenditured and they're written off the date you charged them.
Yes.
See, you have personal liability. The theory is you have personally liability on that. And see, because all the credit cards, you're personally liable. So you made the decision to not pay it until the next month. You might say, I didn't get the bill, but it's not when you get the bill. So during the year, it doesn't really matter. You can do whatever you want, but you could do it a different way at the end of the year, but you're hurting yourself in a sense.
Okay, thank you.
You're welcome.
I saw Chris unmute his mic a few times. Do you have questions, Chris, or were you?
No, I'm good, thanks.
Okay.
Well, there's actually two Chris's.
Yes. I think it was the other Chris.
Okay.
Leanne, your mic's unmuted. Did you have another question before we wrap this up?
No, that's it. I'll unmute.
Okay, very cool. Well, if there's no other questions, then thank you so much, George. Everyone, at 2 o'clock today, we'll be talking with Chad Gates. So he's a local real estate attorney. He'll be giving us a market update, what he's seeing, how they're doing closings with social distancing and reopening back up. As well as tomorrow at 2 o'clock, we will be talking with Sable Palm, one of their representatives and vice presidents. They'll be talking about the small business loans that they have going out, as well as the George, is it the P? It's not PPP. It's P. What's the new program?
As a matter of fact, sometimes I could talk about that because that's all I've been doing for the last 2 or 3 weeks. There's the PPP loan and there's EIDC. The PPP loan will not apply to most of us here unless you have payroll. Without payroll, you don't get it unless you have a side business. And maybe Chris or John or Grace, or I'm joking. Okay, somebody here might have like, oh, I'm in real estate, but I'm also have a side business. I'm doing internet sales or something, and they have a Schedule C. They can get a PPP loan for that. But the EIDC is the real SBA loan. That's where you get the advance up front. And that's literally, I've lost part of my voice the last 3 weeks, not because I have COVID or I don't feel good, I feel great, but it's because I've never explained the same thing almost 600 times to 600 clients in a row. Honest to God, I don't know if you can appreciate that. Could you imagine teaching the same exact thing right 600? It's fascinating because I lost my voice. I'm getting it back now, but literally that's why I lost my voice. But it's the EIDC loan. That's done online. Okay. Not through the bank, but the bank's going to come in at the end. But that you're supposed to get an advance, $1,000 a person. Okay, people have 10 employees, they're going to get $10,000, and it's limited to that. But a lot of my clients got the $1,000 because everybody should be doing that. But the reason you also want to do it, and I'm sorry to take a little extra time, but this is important. The reason is that it's a good rate. It's under 4%. And you want to do it if you can. It's a problematic because I have clients that had applied for it a month ago and they're finally getting around to it. But there's an advance of $1,000 per person because you're going to say I'm the only employee of my own company. Whether you're an employee or not, you're allowed to do that. But you're actually asking for a loan and the bank is going to come back or through the SBA to actually give you a loan. And I like that, especially if you can use it for real estate. Now, you're not supposed to refi, but that being said, there's ways of doing things.
Is it EIDL or EIDC?
EID, there's 2 of them. They're both the same thing, EIDL, whatever the case is.
Okay. So that'll be tomorrow at 2 o'clock. He'll also be talking about Sable Palm is still doing refinances out for rental properties. So we'll be talking about that and what their guidelines are for those things. Next week, we'll be having George at 11:30 again, same access code that you guys have here. And he will be talking about advanced taxes. So we already hit on that a little bit today, but if there are no other questions, then I'll let George get back to all of his fun accountingness. And thank you so much for joining us.
It was a pleasure for me. Thank you very much.
Bye, y'all.
Bye.
Thank you.